While you were sleeping, one signature changed everything. No war. No warning. Just one economic decision, and by morning, millions were bankrupt. Savings vanished. Banks froze. Markets collapsed. The question is, could it happen again? For decades, the world economy was built on one promise: stability. People believed that if they worked hard, saved money, invested wisely, they would be safe. Governments promised growth. Banks promised security. Economists promised balance. But history shows us something different. Economic systems are not unbreakable. They are fragile. And sometimes, they depend on one decision. To understand how millions were bankrupted overnight, we need to understand something powerful: trust. Money is not just paper. It's trust. Banks don't physically hold all your money. They lend it. Governments print currency based on confidence. Markets rise because people believe they will rise. And when trust breaks, everything collapses. Let's travel back to a time when one announcement changed everything. In 2008, the world watched as major financial institutions began collapsing. But before the crash became visible, there were signs. Banks were lending money to people who could not afford homes. Mortgage approvals were easy. Credit was flowing like water. Housing prices were rising fast. People believed real estate prices could never fall. Wall Street packaged risky loans into complex financial products and sold them globally. Investors bought them because rating agencies called them safe. But they weren't safe. They were ticking time bombs. Then came the decision that shocked the world. On September 15, 2008, a major investment bank was allowed to fail. That bank was Lehman Brothers. When the government decided not to rescue it, panic spread instantly. Markets crashed. Stocks plummeted. Credit markets froze. Businesses couldn't borrow. Payrolls stopped. In just days, millions lost jobs. Homes were foreclosed. Retirement savings disappeared. Families who had done everything right were suddenly bankrupt. Why? Because one economic decision sent a message: no one is safe. When Lehman fell, trust collapsed globally. Investors pulled money from banks. Banks stopped lending. Companies stopped investing. Consumers stopped spending. The economy froze. Within months, the global economy entered the worst financial crisis since the Great Depression. In the United States alone, over 8 million jobs were lost. In Europe, banking systems trembled. In Asia, exports collapsed. But 2008 wasn't the only example. Let's look at another moment: different country, different reason, same devastation. In 2016, in the middle of the night, a surprise announcement was made in India. The Prime Minister, Narendra Modi, declared that 501,000 rupee notes would no longer be legal tender. 86% of the country's currency became invalid overnight. People rushed to banks. Long lines formed. Small businesses that relied on cash were paralyzed. Daily wage workers couldn't get paid. Weddings were cancelled. Hospitals refused old notes. The goal was to fight black money and corruption. But for millions of ordinary citizens, the impact was immediate financial shock. Small shop owners lost savings. Farmers couldn't buy seeds. Informal workers had no income. Again, one decision. And millions were financially broken overnight. Let's go further back. In 1971, the United States made a historic economic decision. President Richard Nixon announced the end of the dollar's convertibility to gold. This effectively ended the gold standard system created after World War II. The decision, known as the Nixon shock, changed global finance forever. Currencies began floating freely. Inflation rose sharply in the 1970s. Savings lost value. Oil prices surged. While it didn't bankrupt millions overnight instantly like a market crash, it triggered years of instability and inflation that destroyed purchasing power. People who had savings saw their money buy less and less each year. Silent bankruptcy. Now let's analyze what these events have in common. First, concentration of power. A small group of policymakers can influence billions of lives. Second, interconnected systems. When one institution fails, others follow. Third, psychological panic. Economic collapse spreads faster through fear than through math. But here's the deeper truth most documentaries don't tell you. Crises are rarely accidents. They are often the result of incentives. Banks chase profit. Politicians chase votes. Corporations chase growth. And when risk builds quietly, it explodes loudly. So how exactly do millions go bankrupt overnight? It happens in stages. Stage 1, easy credit. People borrow more because money is cheap. Stage 2, asset bubble. Housing, stocks, or crypto rise rapidly. Stage 3, policy shift. Interest rates increase or liquidity tightens. Stage 4, collapse. Debt becomes unaffordable. Prices crash. Stage 5, panic. Investors rush to exit. Banks freeze. Stage 6, bankruptcy. Let's take housing in 2008. People bought homes with small down payments. When prices fell, they owed more than the house was worth. Banks foreclosed. Families lost everything. Let's take demonetization. Cash-based businesses suddenly had no working capital. Without liquidity, small businesses die fast. Now let's look at something modern, inflation after 2020. During the pandemic, governments injected trillions of dollars into economies. Central banks lowered interest rates near zero. Markets surged. Crypto exploded. Stock prices soared. Then inflation hit record highs. Central banks reacted by raising interest rates aggressively. When interest rates rise, borrowing becomes expensive. Businesses struggle. Mortgages become unaffordable. Asset prices fall. Once again, policy shift. Once again, financial pain. The lesson. Economic decisions are powerful because they affect the cost of money. And money is oxygen for the economy. Remove oxygen, the system suffocates. But here's something important. Not everyone goes bankrupt during crises. Some become richer. During the 2008 crash, investors who had cash bought assets cheaply. After demonetization, digital payment companies grew rapidly. After inflation spikes, certain commodities rise. Economic collapse redistributes wealth. It doesn't destroy it, it moves it. That's why understanding economic policy is not optional anymore. Let's break down what you must learn from history. Lesson 1: Never assume stability is permanent. Booms feel safe until they aren't. Lesson 2: Avoid overleverage. Debt multiplies risk during downturns. Lesson 3: Diversify assets. Cash, investments, skills, not all in one basket. Lesson 4: Watch central bank policies. Interest rates are silent weapons. Lesson 5: Liquidity is survival. During crisis, cash flow matters more than profit. But beyond personal finance, there is a moral question. Should governments rescue failing institutions? In 2008, some banks were bailed out. Critics argued that rescuing them rewarded reckless behavior. Others said letting them fail would collapse the system. It's a dangerous balance. Too much rescue creates moral hazard. Too little rescue creates collapse. The decision regarding Lehman was meant to teach discipline. Instead, it triggered panic. History shows that economic systems are emotional systems. Humans react. Fear spreads faster than logic. And when fear spreads, people sell first, think later. Now imagine being an ordinary family in 2008. You have a mortgage. 2 children. Savings invested in stocks. One morning, markets are down 20%. Next week, your company announces layoffs. Within months, your retirement savings drop by half. You didn't gamble. You didn't speculate. But you were connected to the system. That is the hidden truth of globalization. No one is isolated anymore. A policy decision in Washington can affect farmers in Asia. A banking collapse in New York can affect factories in Europe. Because finance is interconnected. And that is why one decision can bankrupt millions overnight. But here is the powerful twist. Crises also create reform. After 2008, banking regulations tightened. Capital requirements increased. After demonetization, digital payments expanded dramatically in India. After the gold standard ended, global trade expanded under floating currencies. Every crisis reshapes the future. So the real question is not, will another economic decision shock the world? The real question is, will you be prepared when it happens? Because history guarantees one thing. Another decision will come. Another policy shift. Another unexpected announcement. Maybe about interest rates. Maybe about currency. Maybe about digital assets. Maybe about taxation. And when it comes, people who understand the system will react calmly. Those who don't, will panic. And panic is expensive. Let's end with a powerful reflection. Money feels solid. Banks feel permanent. Governments feel stable. But economics is built on confidence. When confidence breaks, everything changes. Millions learned this the hard way in 2008. Millions felt it during demonetization. Millions experienced it during inflation shocks. One decision. One announcement. One policy shift. And overnight, bankruptcy. But knowledge is protection. Understanding economic cycles is protection. Diversification is protection. Patience is protection. If you've stayed till this point, you now understand something most people ignore. The economy is not random. It moves in cycles of boom and bust, risk and correction, optimism and fear. And the difference between survival and bankruptcy is awareness. So the next time you hear about interest rate hikes, or government monetary policy, or banking instability, don't scroll past it. Because behind those headlines could be the next decision that changes everything. If this documentary opened your eyes, if you learned something new, if you want more deep, powerful real-world financial stories, subscribe. Because understanding money is no longer optional. It's survival. And the next economic decision may already be on its way.